traditional locations. I just ask if both of you could comment on, again, maybe trying to focus on changes or trends you're seeing in real time over the last year, but focusing on New York City. And are there pockets in New York City you guys are more optimistic on than others? So maybe we'll start with Paul.
Sure. Listen, I think as a general matter, as we look at the market and what's changed, whether it be in New York or in other parts of the country, first thing that we really are focused on right now is your hold duration. I think there's a lot of volatility in the world. Things have gotten pricey. So I think as we look at assets, we're making sure whether we're buying or developing, we're very focused on the location and the quality with the expectation that we're going to go through some bumps in the road in the near term. So you have to have a longer term business plan and be more flexible. So I think that's just at a very high level the way we're looking at things. And although we've been active, in New York in particular, most of our activity has been focused around development. I think that pricing for New York assets right now has gotten, sort of at the top end of the market. For the right asset doesn't mean we're not still looking at existing product, and we are looking at it. And to the extent you can find something that's great and you think that long term over the next 5, 10, 15 years, your entry point is less important as long as you have that type of horizon. We'll look at existing, but most of our focus, New York, we've been very active in the city itself in Hudson Yards over the past couple of years and tying up a few land sites there. We've been very focused, more so in what we call our hub and spoke mentality, where we look at New York and as things become more expensive on the office side, more expensive on the residential side, where are the nodes of activity that are well connected from a transportation standpoint, where people are going to seek opportunities from an office and a residential standpoint that could really be a good outlet for New York and a release valve. And we spent a lot of time in the last few years focusing on Brooklyn and as well as Long Island City. Long Island City, we happen to be fortunate that in one of the prior downturns, we were able to tie up about 2 million square feet of development rights in Long Island City. And we're very active now in moving forward with that. We just broke ground on 1,900 units of multifamily in Long Island City right now, which literally sits on top of 5 subway lines, and you can be at Midtown Manhattan in less than 10 minutes. So it's really looking at development where it's well connected to transportation in the outer boroughs, and looking at that where the spreads and for taking development risk are probably 150 to 250 basis points inside of where cap rates are today. So we think on a risk-adjusted basis, we'd rather be developing if you're really looking at a medium to short-term view than acquiring today.
Sush?
Yeah, we would echo some of those thoughts. I mean, we're big believers long-term in New York City. It continues to be a very attractive place for young graduates, many like yourself, that'll stay here and then have families, and life just happens, right? You're stuck, so that's all good for the longevity of New York. I would say we're very local, so we're going block by block, and the real estate business is an inefficient business. There's a lot of details that matter. And so when we go block by block and we study those details, you can usually find some inefficiencies, some dislocations. But it's sifting through literally probably, we probably in our firm, in our New York office, look at more than 5 ideas a week, so that's maybe 250, 300 ideas a year. We probably tour 2 buildings a week, that's probably touring 100 buildings a year. We probably do 2 or 3 or 4 deals a year, right? And so that process of elimination is where you can have some conviction, right? Just by, okay, we looked at all these other things, these things make sense on a risk-adjusted basis. They're in a path of growth, they're in a good area. And then obviously it goes to capital structure, right? There's probably gonna be a dip at some point. It's a cyclical business, so that's why we try not to use a lot of leverage. If we're buying a vacant building, let's buy it unlevered. And let's hold it unlevered until we get it stabilized. Once we get it stabilized, then we'll put on some debt. Obviously that brings returns down, but you know, obviously in a downside case, you can withstand through the cycle, and that just becomes a function of communicating with your investors and making sure, you know, everyone's going into it with the same understanding.
So Brandon, Shorenstein has been a real thought leader in terms of focusing on creative office space and investing in not only cities but buildings and locations that cater towards, you know, pick a buzzword, millennials, creative class, et cetera, et cetera. You know, has anything changed with respect to those trends in the last year? Are there markets you guys